Susan, go ahead and start. You're live.
Okay, good morning, everyone, and welcome to the second day of VICA's 32nd Annual Business Forecast. My name is Susan Cifuentes Trigueros. I am the Interim Director of Regional Public Affairs for SoCalGas. SoCalGas is proud to be a presenting sponsor of the event along with Wells Fargo. I hope you enjoyed yesterday's conference. And today we have an equally dynamic program with Tom Nealon, President of Southwest Airlines, as our keynote speaker. Don't forget to check out all the virtual exhibitors. Remember, you need to visit them all and download the raffle page from each to be entered into the raffle. Let's also thank our economic forecast sponsor, Bank of America. As part of the SoCalGas team, it has been a pleasure to partner with VICA since 1988. We all know VICA membership is a great investment because it is among the best business advocates that deliver tangible results. At SoCalGas, we believe California deserves clean, affordable, reliable, and resilient energy. And at SoCalGas, we have played a significant role in securing California's clean energy future. Recently, we partnered with Bloom Energy to install fuel cell technology with microgrids to help power 2 of our facilities. This type of technology represents the type of forward-thinking innovation that will help shape the future of SoCalGas and our state. There are also major innovations happening in renewable natural gas, where SoCalGas is ahead of our goal to deliver 5% of our core gas by 2022. And in hydrogen, where we're advancing a strong portfolio of potential projects. Through innovation, SoCalGas has been and will continue to be the leading contributor to decarbonizing energy in California. While some shy away from us because of our name, we are not afraid. We are intent on shaping the future energy by leveraging our strengths and advantages for the benefit of our customers. And we'll continue to partner with the communities we serve in ways that positively impact, especially those most in need. In conclusion, I'd like to acknowledge Stuart and his incredible team for always coming through and standing up for business. VICA has been the leading advocate for the San Fernando Valley business community for over 70 years. We've needed VICA more than ever as they've tirelessly advocated for the region's job creators through this health and economic crisis. We're glad you've joined us today as most businesses are adapting and overcoming to survive in what will be a post-pandemic era. From tourism to travel, to what our future workforce looks like, to healthcare, diversity, and the news. All the issues our panelists discussed today are intertwined. Since 1988, VICA's Business Forecast Conference has brought leaders across the business, political, nonprofit communities to work through the challenges and opportunities the San Fernando Valley faces for the year ahead. The Economic Forecast Breakfast is the centerpiece of this conference. I hope you're still enjoying your bagels and coffee from Western Bagel and the super cool swag box you all received. At this time, I'd like to introduce our moderator of our economic forecast today, Redonna Carpenter-Woods from Bank of America. Redonna?
Good morning, and thank you, Susan. So now, as you can tell by the theme of the event this year, surviving in a post-pandemic era, we are looking to what comes next in our economy. We are glad that you joined us today as we prepare for what lies ahead, which is really what business people do every day. Work hard, create jobs, and try to survive and succeed. But when will the economy come back, and what does it look like? I've been in banking for over 30 years. I've made it through the 2008, 2010 recession and the shock to the banking system. I was in my early years of banking during the stock market crash. However, the current environment feels a little different to me. It's triggered by a global pandemic, governmental and societal responses to it, and the resulting shocks to supply and demand. We in banking have felt the effects of this crisis, and all signs indicate that we're not done yet. We have challenges ahead, and the banks will need to play a role in getting the economy back on track. The role of the bank will play is dependent upon the resilience and the health of the bank. The capital cushions for most banks are adequate and others are challenged. What I can say today is that I'm not an economist, and that's why I'm so excited to hear from our speakers. VICA's Business Forecast Conference is one of the premier events in Southern California region, with the best economists always available. By bringing together knowledgeable economists, business leaders are given information that will help them prepare for what the future holds. The best way to ask a question of our speakers today is for you to click on the link below the Zoom, and then you can type in a question that the speakers will see and can answer. Or if you want to stay on Pathables, please send your question through the chat box on the Pathable, and the VICA staff will make sure that your question gets over to me to ask. Our speakers have prepared some very important information for us today. So let me introduce our economist very quickly, and then we'll get started. So first, we have Jeff Kravetz, Regional Investment Director for the Private Client Reserve of US Bank. And then we'll have Charles Dougherty from Wells Fargo Securities. At this point, I would like to turn it over to Jeff.
Great, thank you. Can you all hear me?
We can.
All right, fantastic. So this is my 6th time doing this VICA conference. It's one of my favorite events of the year. So I'm thrilled to be here. We have so much to talk about with regard to the economy and capital markets. So let's jump right in with the first slide. Great. Here are my upfront conclusions. First, we at US Bank maintain a glass half full perspective with regard to portfolios. Second, vaccine development, we believe outweighs election results in the long run. And finally, we must respect those risks. So let me briefly touch on each of these. So why do we have a glass half full perspective? That's because of the incredible stimulus on behalf of the Federal Reserve and Congress that's gone in to the economy. Also, we're working on a vaccine, and that's incredibly exciting. Now, with regard to the vaccine, that's really what we're focused on. I know we have the election next week. People are very nervous. Investors are nervous about the election, but we're going to get through that. Then we're going to be on to working through the COVID crisis. And finally, we have to say, you know what? There are risks out there. There's risk of a contested election. We've seen spikes in COVID-19 recently. So those could disrupt markets and change policies. So let's take a look at capital markets with our first slide here on the stock market. All right, this is not my EKG. but it is a chart of the S&P 500. And the title here is We've Witnessed and Respected a Wide Range of Outcomes over the last 12 months. So take a look at the graph. This is the US stock market, and look at that huge spike down from February down to the end of March. And that was when COVID really came on strong. And then March 23rd, that's when the Fed stepped in and said, we are going to be aggressive. We're going to spend up to $2.3 trillion buying bonds and bond funds. And look what happened. Along with the fiscal stimulus, we've had this incredible rebound in the stock market. So that drop and rebound is the fastest bear and bull market ever in the history of the stock market. Next slide. So when you look under the hood of the stock market, not all sectors of the stock market are doing equally as well. So this really breaks it out. And you look at those top lines, that top dark blue line, that's technology. And that's done incredibly well due to the stay-at-home economy. Those are companies like software companies, social media companies, companies related to e-commerce. Then the next line down, that light blue line, that's healthcare. Healthcare tends to be a bit recession-proof, also has gotten a boost because of all the research and development on therapeutics and vaccines. So what hasn't done well? What hasn't done well are the lines on the bottom. So that light green line, those are financials. And that's due to the big fall off in interest rates and also the uncertainty with regard to the economy. And then finally, the biggest loser, if I would have to choose one here, unfortunately, is energy. Energy's gotten crushed due to the big fall off in demand for oil and gas. We're not traveling, we're not taking trips as much. So that's really hurt energy. Next slide. All right, if we take a wider look at capital markets across the world last year and this year, it really provides a good perspective to see how we're doing. So these are different markets around the world. 2019, look at those returns. Those are annualized returns. Okay, the S&P 500 up 32%. Look at all those returns. International stocks did well, bonds did well, commodities did well. If I could just freeze that as a portfolio manager and have those returns every year, that would be fantastic. This year, however, year to date 2020, it's a mixed bag. If you look at the stock market, we're up. We're in a little turbulence this week. So let's say we're up around 5% in the US stock market. MSCI EFA, that's Europe and Japan, primarily Europe, down this year. Emerging markets are up. The center line there, or center row, that the Barclays aggregate, that's the taxable bond index. And that's backed off a little bit. It's up maybe around 5%. And then, as I mentioned, commodities are really taking the brunt of it, doing very poorly. Now, what's interesting on this chart, I want to point out, is the Wilshire US REIT. REITs are real estate investment trusts. So you would think that with rates going down, REITs would do well. That's the normal playbook. But this year, that's not the case because of the uncertainty with regard to how much office space, how much retail space we're going to need when we get through this pandemic. Next slide. All right, we've got a lot of nervous clients. We counsel our clients on what to do with their portfolios. And unfortunately, clients, when they get nervous, they tend to do the worst thing at the worst time and try to time the market and sell stocks when the market's way down. So this slide is making a case for why you should stay invested in markets. And this slide shows if you stayed fully invested versus if you missed the best days in the stock market over the last several decades. So let's take a look. It's the return on the S&P 500. It's a 30-year time frame. So that large bar on the left, where it says 9.96%. If you had invested $10,000 in the stock market 30 years ago, it would have grown to 172,000 and change. Trust me, the math works. It's due to compounding. And your average return would be about 10%. But if you miss the best 10 days of the year over that time period, your return drops. If you miss the 20 best days, now look in the center of the graph, if you miss the 30 best days, that's only one of the best days in the stock market a year for 30 years, your return goes from 10% down to 4%. So a very compelling case to stay fully invested in markets. Next slide. Now, let's take a look at some of the economic drivers of the economy. And the biggest economic driver of the economy here in the US is credit. Credit is crucial. It's the lifeblood of the economy. Without credit, the economy can't really grow. And availability and access to credit is key for businesses and individuals. This chart shows the growth in credit going back to World War II. And you can see that big spike coming out of World War II. Then as the decades progress, you see the ebb and flow of credit with recessions and expansions. Now go over onto the right-hand side, around 2008, you can see that that was negative. And then we've had a nice rebound. We are actually still positive with regard to credit growth despite the pandemic. And the good news is that credit markets are healthy, credit's flowing. So that's an important factor for the economic recovery. Next slide. Another very important factor when we look at the economy is inflation. And I used to have an economics professor in college who said, listen, Jeff, if you get stuck on an exam and you don't know the answer, just write down inflation and I'll probably give you partial credit. And the more I do this, the more I realize that inflation is such a key metric. The reason it's so important is because inflation is really the speed limit for the Fed with regard to how high they can push up rates or when they can bring them down. So the title here is Inflation, the 2% level is a gravitational pull. That is the bogey for the Fed, 2%. And what you have on the chart here are various levels of inflation, market levels and also government levels over the last decade. And the bottom line here is that inflation hasn't really broken through consistently that 2% level. So it's allowed the Fed to keep rates very low. And actually the Fed, in many instances, are more worried about deflation, prices going down, which is actually a very big problem for the Federal Reserve. Now, it's not on this chart, but I do just want to mention GDP, or gross domestic product. That's really the growth of the economy. We got third quarter GDP yesterday, which was very good. On an annualized basis, up 33%, the biggest ever. But remember, in the second quarter, the GDP fell about that rate. So if you're looking year over year, we're still down about 3%, but actually not bad considering all the stress we've been through in the economy. Next slide. All right, we've got to take a look at interest rates. And this is a chart of interest rates going back over 100 years, long-term treasury rates. And you can see that they peaked in the early 80s at about 15% and have been on a downward trajectory ever since. Rates right now on the right-hand side where you see October 19th, 2020, right now, the 10-year US Treasury is below 1%. It's 80 basis points or 0.8%. So rates are incredibly low. And Jerome Powell, the chair of the Federal Reserve, has said, you know what, we're not even thinking of raising rates. And that's good for the economy. Rates are low and credit is available. Next slide. But it's not just the level of rates which are important. You have to actually look at individual credit markets or fixed income markets to see if there's stress going on in the market. And what we have here are the index levels on two fixed income markets. One is leveraged loans. Those are bank syndicated loans. Sometimes they're lower quality, used for mergers and acquisitions. Then we've got commercial mortgage-backed securities. So here are the indices going back to before the Great Recession. And look at those indices, how they spiked down in tandem around 2008, early 2009, and rebounded quite well. And look at the leveraged loan market from 2016 to really February, how well it was doing. And then that huge spike down, that was all the stress in the credit markets. And the Fed came to the rescue, intervened in markets, and you can see that big spike back. So we really monitor these markets, the high yield market, municipal bonds, all fixed income markets, to see if there's stress in credit markets. Next slide. So for the month of October, what are the focal points? Obviously the election. Results and policy outcomes are going to be key. And there's potential, depending on how the election goes, for significant changes in tax policy, regulation, spending policy. So that's front and center with the mind of investors. Then of course, medical progress, how close are we to getting a distributed solution, vaccine solution. And then finally, the resurgence risk. And you know what, in COVID-19, I'm gonna hit each of these and speak a little bit about them. Next slide. All right, the election is right around the corner. I think we're up to 80 million people already have voted by mail. This is going to be a historic election with regard to turnout. So what you're looking at here is the prediction market for who's going to win the presidency, President Trump or Vice President Biden. So take a look at the prediction market. This is where you can actually put down money to see who's going to win. Now, up until about May, they were pretty close, and President Trump had the edge. And then with the rise of COVID, Biden really pulled ahead, and that you have a pretty wide margin of Biden leading. Now, we all know that polls can be very unpredictable. And actually, if you look under the hood here, it's really a lot closer than this graph would indicate. In the swing states, the race is definitely tightening. So it's by no means in the bag here for Vice President Biden. And we know that anything can happen in elections. Next slide. All right, it's not only the presidential election that we're really focused on, but it's the Congress, all right? So this graph shows the various combinations that we may get with regard to the Congress, the Senate and the House, if they're Democrat or Republican. So these are, predictions. So here we've got that blue line on the top, and that is if the Democrats are successful and flip the Senate from Republican to Democratic control. And we have a Democratic Senate and we have a Democratic House. So that's, right now, that's the most favored. And then underneath that is the gray line, which is the House and the Senate remain the way they are. The Senate's Republican, the House is Democratic. Now, again, I gotta caution you. These races, especially the Senate races, are really heating up. They're very close. I'm in Arizona. There's an incredibly close race here. So, this is very close, and it could go either way. So the question you might ask is, hey, Jeff, what's the outcome of some of these results? What if we do get a blue sweep? What if we get the Democrats taking control of the Senate, retaining the House, and President Biden wins? Well, that would be a very significant event for markets. It could create a lot of short-term volatility as investors get used to a new regime, with regard to taxes, regulation, and spending. Now, if we get, a mixed result, which means we have gridlock in Congress, and we have, a mixed Congress, investors may take that positively because they're used to gridlock, and they can kind of, work with that and predict, based on the past, how things may unfold. Next slide. All right, let's take a look at the vaccine. That's on everybody's mind. And what this is a graph of a prediction of when we're going to get the vaccine. And this is by super forecasters. People are very good at predicting these big events. It asks, when will there be enough FDA-approved COVID-19 vaccine doses to inoculate 25 million people in the US? We know that's just a start. We have over 300 million people. But the best guess is it's going to happen between the end of January of next year and May. Now, if that happens, that's pretty amazing because vaccines usually take 5 years or more to get approved. And that would mean that a vaccine that's so widely distributed would be approved within the 1 to 2 year timeframe. So we're really focused on that, as well as everybody in the investment community, and of course, businesses and consumers. Next slide. Now, this is unfortunately one of the more disturbing slides in my deck, and it's the growth of COVID-19 cases recently. So let's take a look at the different regions. That gray line that really spikes up, that is primarily Europe. And recently, Germany and France have initiated some lockdowns to try to control the spread of COVID-19. And then you've got that blue line. We peaked in over the summer, and we're starting to see infection cases rise. So this obviously is really front and center with regard to investors, with regard to the economy, with the ability, let's say, to get more stimulus and to help companies and consumers bridge the gap to when we get a vaccine. Next slide. All right, this slide is our economic health check. And what we do in our asset management group at US Bank, we track about 1,000 data points from across the world. Everything from inflation, consumer confidence, purchasing managers indices, things like that, to get a sense on how the global economy is doing. So at the top, it says financial markets do not equal economics. And that's just really a headline saying sometimes the stock market, the bond market, they get ahead of what's going on in the economy. Let's take a quick look and see how we're doing. And if you look on the upper right where it says expansion, there's 4 quadrants: expansion, slowdown on the bottom, then you go over to recession and recovery, all right? So if you look at the data, where's most of the data? Look at recession, 578 data points are in recession. However, if you kind of take a snapshot of a few days, fairly recently, you see that data trending into the recovery stage, especially emerging markets, US, unfortunately not Europe. Europe is having a little more trouble economically, with the virus. So we really use this to gauge how the economy is doing. And in the end, it kind of dictates where we're going to put capital around the world. Next slide. This slide's busy, so I'm going to walk you through it. Earnings. We are right in the heart of earnings season for S&P 500 companies. Last night, we had some big earnings from some major tech and consumer companies, Amazon, Alphabet, Apple, Facebook, which generally reported pretty good numbers. So the headline is earnings are projected to trend higher. These numbers must reflect a more realistic path. So let's see where we are in earnings. If you look at the table in the center, these are earnings estimates for the S&P 500 for different years by different providers. So go down to see where it says blend. 2019, earnings for the S&P 500 are about $160 a share. This year, they're expected to drop to $132 per share and then reaccelerate to $166 per share. So this year-over-year earnings are going to be down around 17%. And we're looking, as you go out further into the next year, earnings to recover up to around 26% year over year. So earnings are going to be key. But what's really important on these conference calls is not how earnings were, in the past quarter, but what guidance companies are giving, how business is doing, for the next few months and what they see the outlook is. Next slide. All right, we're to my last slide here. So I'm going to wrap it up, give you the bottom line before we open it up for some questions. So here's our bottom line. Despite all the issues with the pandemic, the election, we do maintain that glass half full perspective. But listen, don't be a hero. We do favor stocks over bonds, and we favor US stocks over international stocks. Also, with regard to medical progress, that's going to be key. We need that vaccine to really get us to the next level. We have to bridge that gap. And there is a lot of momentum that's picking up consumer demand that could be unleashed if we do get a vaccine sometime next year. Finally, we're looking to that second time horizon when we do get over that bridge and get to the era where we do have a vaccine and the COVID-19 virus is under control. So we have to look at further issues, with regard to inflation, credit, how capital markets are doing, and make sure that we're advising our clients and giving them realistic expectations for where we may be in different capital markets. So that's it for my prepared remarks. I'm going to stop there, turn it back to Redonna, and we're going to take any of your questions.
Jeff, thank you very much for that. You've given us really a lot of nuggets to think about. And so what I'd like to ask is that everybody hold their questions, and we're going to take those after we hear from Charles. So at this time, I'm going to turn it over to Charles, and we'll definitely come back with your question. Charles, it's yours. Take the floor.
All right. Well, thank you very much. And that was a very, very interesting presentation there, Jeffrey. So thank you for that. Super interesting. Before I start, I just wanted to say, one, congratulations to all you Dodgers and Lakers fans. I'm actually from Philadelphia, and we've won 2 championships in the past 40 years. So you congratulations again. That's super exciting. What I kind of wanted to do was talk about what's going on in the economy. I want to talk about what's happening at a high level, but also what's happening more in terms of California and the greater Los Angeles region, because, frankly, there's a whole lot to talk about. So I'm not sure if we can pull up some slides here or, on this first slide, I just wanted to sort of extend on what Jeffrey was talking about in his one slide about the coronavirus, because, it's really important on how it's impacting the economy. So what you're looking at right here is sort of a different view of what's happening, by state in terms of the economy. You can look at what's happening in California. What this basically shows is the number of new COVID cases per 100,000 people. And we sort of put the numbers in that way to sort of control for different sized populations. So you can see by this map where, the new outbreaks or the next iteration of the coronavirus is happening. It's really in the Midwest and sort of mountain west parts of the country. So a higher number means, more spread of the virus. So you can see, North Dakota, South Dakota, Wisconsin, these areas are now really getting hit fairly hard. And I kind of want to point this out, is because if you think about, the past 8 months, what we've seen, the Northeast and West Coast were really, the ground zeros of the first wave. And then it kind of moved towards the Southeast and Sunbelt regions over the summer in places like Florida, Texas, Arizona, et cetera. So now it's sort of kind of filling in, unfortunately, in the Midwest. And like I said, some of the mountain states. So, if you look at what's happening in California, California cases still remain quite low relative to where they were in the summer. So that's a good thing. But, of course, that the fact that there is this new quote unquote wave of the coronavirus is somewhat concerning for the economic outlook, because as we found out this summer and early spring, as the coronavirus goes, so goes our economy. And as Jeffrey pointed out earlier, it's really dependent, a full economic recovery is really dependent on us, containing and defeating really the coronavirus, either via therapies or a vaccine or something like that. So anyway, on this next slide, I'm just showing you, what our outlook is for the overall economy. And this is real GDP growth. When we talk about economic growth, this is generally what we are talking about. We're talking about gross domestic product. And, we did get the most recent data point for GDP yesterday. It was a strong number, 33% growth. Of course, we shrank about that much in Q3. So it was I'll call it a partial bounce back because you're coming off of a lower base. We're not all the way back to where we were. So there's a few important things that you want to pay attention to on this graph. One is that blue line, which shows your forecast. So what we're forecasting now, giving the current state of everything, some of the assumptions that are behind this line are, that we do eventually get a vaccine at some point over the next few months. It's widely distributed over next year at some point. And some of the momentum that we've seen over the summer continues. Maybe we see a slowdown in economic growth and job growth and things like that, but we're still in solid positive territory. So considering all of these factors, what we have is, we're probably not going to get back to where we were at the start of this year until midway 2021, probably in the third quarter at some point. So that's just getting back to where we were. That's just getting back to the peak. Now, if you imagine a dotted line continuing, imagine a world where the coronavirus never happened and the economy continued to grow at a 2% trend-like pace. We don't have us getting back to where we, were supposed to be until after 2022. So we still, the big impacts from the coronavirus is certainly there. It'll probably be, lasting. We are on the path to recovery. It's going to be a long road and probably a long and winding road, but we are on the path, right? And judging by the latest, GDP number that we saw yesterday, are we going to see those huge numbers again? Probably not. We're digging ourselves out of the hole. We're going to start to see more normal numbers, right? If you get any updates on your phone, for the economic news, we're going to see smaller and smaller numbers. That just means we're slowly and gradually recovering, which is a good thing. It's where you want to be. Again, we're still a little ways off in terms of fully recovering or getting back to where we were supposed to be, but we are on the way there. So this next graph or this next slide, California has, it's an interesting state. And I love talking about California because one, in my opinion, it's one of the greatest states, in the country for a variety of reasons. And if you listen to the news media right now, it's all against California, California this, California that. But California, in terms of their economy, there is sort of a lagging trend here in terms of the rest of the country. California is definitely on the road to the recovery, but if you think about how hard hit the state was in terms of the coronavirus, which remember drives economic outcomes, in this day and age, if you think about how hard hit, San Francisco and Los Angeles was by the coronavirus, it's only natural to see that their economy is lagging behind a little bit. So one of the ways we sort of track this is we're just looking at job growth. Every month we get new jobs numbers, but how many employers added to payrolls during the month. So the bottom left-hand graph, you can see in March and April, California lost over 2.5 million jobs, right? So that's a whole lot of jobs to get back. And in the months afterwards, California has made a lot of progress. Not it's been a little bit slower compared to other states, but like I said before, California had to be very, very cautious in reopening their economy because the pandemic was so widespread. So it's only natural to see that it's been a little bit slower, but the state is making a lot of good progress. So they've regained about 1 million of those 2.5 million jobs that were lost. So that means there's still a gap of about 1.6 million jobs to go. So it's still a long recovery ahead. But overall, this is what you want to see. You want to see progress, right? No going backwards. And California has added, for the past 5 consecutive months, added to payroll. So this is, like I said, what you want to see, progress. California will start to catch up. And remember, those states that are seeing, widespread coronavirus outbreaks right now, their economies, unfortunately, will probably start to slow down a little bit, and California is going to catch right up. Another way to think about this is if you look at the unemployment rate, right? So we have the national unemployment rate that's just a shade below 8%. California's unemployment rate is still quite high, right? But that's what you would expect because of the cautious nature in which the California economy has begun to reopen. So it's still very high. It's higher than the national average, but like I said, this is what you'd expect to see. And if you look at what's happened in other states, for example, New Jersey had a very similar high unemployment rate a month ago. It was around 11%. And in just 1 month's time, it fell to about 7%. So that just speaks to how quickly things can recover, once you start to, put the coronavirus more in the rear view mirror. So on this next slide, what we see is, there's a lot of ways to sort of gauge what's happening in a local economy. And unfortunately, because of everything that's happened over the past few months, the swift and severe impacts of the coronavirus, we've had to, as economists, we've had to sort of turn to sort of alternative data sets, which kind of show the economy from different aspects. So one of the ways we're looking at the California economy is through the lens of consumer sentiment. Now remember, the US economy is primarily driven by the US consumer. It's about 70% of the overall total US economy. So as the consumer goes, so goes the rest of the US economy, and so goes the California economy. So consumer sentiment is extremely important. And the fact that what you can see in this graph is that blue line, that's California. You can see consumer sentiment is slowly beginning to catch up to where sentiment is in the rest of the country. So this is exactly what you want to see. Remember, California is lagging behind right now, but they probably will, start to catch up. And this gauge of consumer sentiment says exactly that. So that blue line is, getting better, slowly catching up to that brown line, which shows consumer sentiment in the rest of the country. So that's exactly what you'd hope to see. How that translates to actual consumer spending, it's sort of telling the same story in that bottom right-hand graph, right? So that that orange line is consumer spending in the United States. That blue line is total consumer spending for California. So California is still, again, lagging a little bit behind where the rest of the country is. If I had to guess, spending is going to catch up as more parts of the economy start to open up in California. But look at that brown line at the bottom. That's spending at arts and entertainment and recreation, which is such a huge driver of the California economy, right? It's such an important part of California, and that type of spending remains very, very low. It was 60% off of where it was at the start of the year. So this is a huge challenge. If you think about all the announcements from theme parks, around California about the unfortunate situations there, that's a big driver of California economic growth. So again, going back to the coronavirus, it's going to be a little while until things start to look more normal. More of the economy is going to open up. We're going to start to steadily, gradually improve. But if you look at that brown line, we need that brown line to start heading up to where those other lines are, because that'll signify, a more full, complete recovery. So on this next slide, drilling down to what's happening in the greater Los Angeles area, it's sort of a similar story, right? Los Angeles lost 1 million jobs, which is a lot. And they've gained 340,000 back. That's about 33% of the jobs lost back. That's pretty good. What's important here is we're back on the road to recovery. Los Angeles if you think about the industries that have been impacted the most in terms of the economic losses, it's not surprising that Los Angeles lost so many jobs. What drives the Los Angeles economy, it's leisure and hospitality, it's restaurants, it's the entertainment industry. So this is a big, economic impact. Where, again, I want to emphasize, we are on the path to recovery, but if you look at this bottom left-hand graph, that's a tall mountain to climb, right? And the other thing, and this is one of the unfortunate aspects of, this particular recession that we've been in, is it's presented us with uneven outcomes. So that bottom right graph shows LA County employment broken out by wage level. So that bottom line shows low income households, how they have fared in terms of employment growth. So you can see employment growth for those, making less than $27,000 a year is still, about 25% below where it was at the start of the year. That, higher income and middle income households have done better. But this is concerning. But it's understandable given the industries that were directly impacted by shutdowns and quarantines, et cetera, right? Bars, restaurants, they tend to, pay on the, lower end in terms of incomes. So it's not surprising to me that these types of, industry sectors have been slower to rebound, if at all. So this is sort of an unfortunate aspect of this particular time that we're in, is that these industries that have been most impacted are going to be slowest to recover just by nature of their close contact, social engagement. So it's going to take a little while. Again, we're slowly improving, we're recovering. But just to reiterate, we're not going to, until we get a vaccine, until we get more therapies, these lines that are struggling are not going to head higher. So this next graph, I did want to, hit on this because it seems to be demanding a lot of attention lately. And it's just, are people, getting up and leaving California? Yeah, probably. But California is a state of 40 million people, right? There's always people leaving. There's always people coming. You always have to sort of remember that. But this shows apartment rents in San Francisco and Los Angeles. And, by this measure, this is the other trend that's sort of happened. People are leaving downtown areas, right? Maybe they're moving to Texas, maybe not, but they're moving to the suburbs, less dense areas. So this is one of those areas that, housing is a very concerning thing right now, because if you think about these apartment markets, which are, the largest apartment markets in the country, the fact that rents are going down so quickly, that's a concern. But the other end of this is, folks are, buying homes, moving to the suburbs where there's more space. Mortgage rates are near record lows. So that's the other end. California housing market is actually doing very well. So home sales across California are doing exceptionally well. Maybe not in the dense urban downtown areas of LA and San Francisco, but on the outerlying areas, even if you go to San Bernardino or Riverside, they are doing very well. So that's going to help the overall state economy continue to recover. So it's always important to remember when you read headlines like this, there's always different things happening in the economy. People come, people go. What matters is the overall economic fundamentals, and those economic fundamentals within California are certainly starting to improve, which is really good to see. So I think this is my last slide here. So I think we can go and move on to the question and answer period. I think you're on mute, Redonna. You're on mute.
How's that? Can you hear me now?
Yeah, that's better.
Okay, great. Sorry about that. So I had some really great things to say. I wanted to say thank you to both Charles and Jeff, because you both have provided some very important information and data points for all of us to consider. So now let's take some questions from the audience, and I have a few from myself. And since I'm the moderator, I'm going to start with one of mine as we formulate the additional questions that are definitely coming in. You've certainly created a lot of interest here. So when we think about the housing prices, and Jeff, I'll start with you. Housing prices are skyrocketing. While the availability has gone down, does this spell trouble for you?
Not necessarily. When you think of trouble in the housing market, think of 2008, right? Why was that so problematic? You know, too much leverage, poor underwriting standards. I mean, that was a recipe for not a good outcome. What's going on here right now with the hot housing market, and I'm in Arizona, in Phoenix, which is a very hot market, is really, it's just a supply-demand imbalance, right? And Charles mentioned it earlier, you know, people moving from cities into more suburb areas. But essentially, there's a really small pool of available homes to be sold, because a lot of people are staying home because of the pandemic. But then you have other people that want to either move to a different state, you know, move to the suburbs. So it's creating high demand with very little supply. And that's why housing prices are really doing so well. And that should probably continue now as we get through the pandemic, and, you know, hopefully things moderate. You should probably see housing prices maybe back off or come down a bit.
Thank you. Charles, is there anything you'd like to add?
No, I would say ditto to that. You know, you're exactly right. 2008, why everything kind of blew up the way it did was because of lending standards. You know, if you look at, you know, profiles right now, people who are buying homes, they appear to be very solid. So basically what that means is people who can afford to buy homes are buying homes, and prices are going up, as Jeffrey noted, because, you know, supply is so low. But remember, mortgage rates are low too. They're historic lows. They're below 3%. So that lets people afford more home. So that's another factor pushing prices up. But overall, like, there's none of the exotic loans are being handed out like they were, you know, in 2007. So right now, the prices are rising. It's a sign of strong demand and scarce supply.
Thank you very much for that. I have a trailing question from actually the audience, and I'm going to start with you, Charles, because you talked a little bit about the California economy. So is there a concern for California if more people are leaving than are coming into the state?
Yeah, I mean, in an ideal world, you know, you'd want to, you know, if you're a state like Arizona, right, you'd want to have high population growth via, you know, migration from other places. But these big places like New York, California, which are big established economies, they are always seeing folks move out. So this isn't really a new issue for the state, and it's the churn, right? You know, have things accelerated a little bit, right, because of the pandemic. If you're, you know, in San Francisco, for example, and your company or firm tells you, you know, hey, you can work from wherever, you know, is everybody gonna, you know, pay those high apartment prices or high home prices in San Francisco? No, you might move to Denver or, you know, Las Vegas or someplace like that. But that's fine, you know, and in economics, that's just, you know, prices go down and then you know, then there's a new equilibrium that gets found, and then they'll start to go back up again. But, you know, is it a short-term, you know, challenge to, you know, state and, you know, local, you know, revenues in terms of, you know, tax collections and things like that? Sure. But, you know, you'll find your way through that. But overall, you know, I'm definitely more optimistic than, you know, all the headlines you hear in the media.
Thank you. There's another question that just came in that I think will dovetail right into that. How will the end of the eviction moratorium affect rent and housing in California?
I think it'll you know, it'll definitely affect things. If I had to guess, my guess would be to extend that. Just because the potential negative impacts would be so big for everybody, for tenants, for landlords, for lenders, for investors. You know, so it would cause such a negative, you know, up and down the spectrum here, that I do think it'll probably be extended. But if you look at what's happening in terms of, you know, people's ability to pay rent, and I don't know what the statistics are for California specifically, but there are some firms that track the, you know, ability to pay rent and the ability to pay rent on time. So if you look at the past few months, renters' ability to pay rent has actually improved very strongly. So for example, in October, just as many renters paid rent as they did as in October of last year. Over the summer, it was lower. So people were having a hard time paying rent and paying rent on time. But as of October, that number actually looks very similar to the same period last year. So, you know, that's not to minimize the situation or you know, what people are going through. But overall, things do appear to be improving.
Thank you very much for that, Charles. I think this would be a great question for both of you. So I'll go back to Jeff on this one. And this is a question again from the audience. Do you see funding the next tranche of government support of industry payments as placing stress on the Fed's balance sheet?
Oh boy. You know, it's not so much the Fed's balance sheet as the national debt. Right. And I whenever I do economic talks, probably the number one question I get is, you know what, we're spiking the national debt. And through this pandemic, you know, the amount of fiscal stimulus has been huge. And placed on top of that, a tax cut we had in you know, 2017. So right now, the debt to GDP ratio, we talked about GDP, is approaching 1-to-1. That means that, you know, if we have a $20 trillion economy, then we have $20 trillion out there in debt. So that is, I'd like to kind of answer it that way. So the question might be like, you know, is it a problem? More stimulus is going to create more debt. On the positive side, it's going to help businesses and we need it. What about the debt side? Well, you know, we are in a pandemic, we're in an emergency. So now is probably the time to do it, right? I'm not saying how much to do. And in the next administration, whoever gets in, there will be another stimulus. It's a question of how big it'll be. But the question is, you know, longer down the road, all this debt, you know, when does it become an issue? And I talked about inflation, I talked about rates. As long as rates are really low, you know, the math works. But when rates go up, that's a problem. And when, you know, interest rates, I talked about the 10-year, when that starts going above, you know, 3%, you know, then it becomes a lot more expensive to finance the debt. So I would really be focused on that. And at some point, you know, we as citizens are going to have to grapple with this debt problem. But right now, in the middle of a pandemic, is probably not the time to do it.
Thank you.
Yeah,
Go ahead,
exactly.
Charles.
Yeah. You know, yeah, so Jeffrey had that great slide of interest rates over the past 100 years. And you can see that sort of trend decline the past few decades. And at the very end of it, you know, or most recently rather, you know, interest rates are at historic lows right now. And what that tells me is there's still a lot of healthy demand for our debt. So right now, I don't think it's a problem when the 10-year Treasury yield is less than 1%. You know, the more the better at those rates, right? So, you know, longer term, is it an issue? Yeah, I mean, if interest rates were to go up in a meaningful way, then you know, the burden would, you know, grow substantially. But you know, what if you look at the deficit, what's happened over the past few years? The deficit's a little different than debt. The deficit, right? It was like over 3 trillion last year. The year before that, it was 1 trillion. Before that, it was like 700 billion. So the continuing rise in the deficit, it's certainly going to, you know, add to the debt over time faster than many of us would have ever expected just a few years ago. So certainly, you know, this is a long-term thing that we're going to have to deal with it. But I would definitely echo Jeffrey's sentiments that right now we're in this, you know, historically unprecedented time. Right now is probably not the time or place to be thinking about debt, especially when interest rates are so low.
Yeah. Fair. I thank you for that. Thank you for that. I had another interesting question that just came in, and I think it would be suitable for both. So we'll go back to Jeff on this one. During the last recession, several municipalities declared bankruptcy. Do you see that happening again?
Yeah, that's a good question. The financial stress on municipalities. And, you know, unfortunately, there is a lot of stress these days because municipalities aren't collecting as much revenue as they did. And so they're having to, you know, reduce services. But one thing that is a little more positive, and California actually did a great job. I give a hats off to California, is when times were really good, they created a rainy day fund, which they can actually tap, which you know, will help governments. But you know, I think the next stimulus, one of the important things in the next stimulus is helping local municipalities because they do need help. They are under stress, but surprisingly, they're dealing with it pretty well with some of those rainy day funds and reducing services. But ultimately, municipalities are going to need the economy, you know, to recover, some assistance to bridge the gap to get to the next level. But we, you know, here at US Bank, we believe that municipalities overall are in a strong position considering, you know, how bad things are with COVID, and should make it through this, you know, period with relatively, you know, few bankruptcies. And, you know, I would just leave it there.
Thank you. Charles, is there anything you would add?
Yeah, I think that sounds right. I would also, you know, the Fed has a municipal lending facility. There's that possibility that could help. And there's also, I think, you know, if you asked me a few months ago, I would have said, you know, the number of municipalities declared, you know, that would be in dire straits would be a much greater number than, you know, current day, because the economy has rebounded a little quicker than many of us thought was going to take place. You know, going back to home prices, right? The fact that home prices have gone up, that's a positive. That'll help municipalities, you know, collect more tax revenue. The stock market has been good. There's some relationship there as well. So yeah, I think, you know, there's always going to be, you know, in times of economic downturns, there's always going to be these areas that you know, are faring poorly. But you know, overall, I think the economy is bouncing back quicker than we thought, and that's going to help municipalities, you know, fare the storm.
Thank you very much for that. it's definitely a unique market for all of us. And if there were a playbook, I think we'd all want to buy it. I'm going to go to the next question. This one's suited for both of you as well. So some of the jobs that's been lost won't return unless there is a vaccine, especially as we have to implement the safety protocols and reduce capacities. What are your thoughts around this particular event? We'll start with you, Jeff.
Okay, yeah. Well, yeah, that is one of the issues, is that we may get some of these jobs that have disappeared. You know, restaurants, more retail, may never come back, you know, that really is unfortunate for places like, let's say, you know, that are dependent heavily, like Las Vegas. You know, LA has a lot of entertainment, things like that. I think what may actually happen is, I don't know if some of these jobs may actually kind of morph, and instead of them being eliminated completely, they may come back just at a slower pace, because I think with the COVID-19 issue, you know, it may not completely go away forever. You know, every year we may take a vaccine for the flu and a vaccine for COVID. And I think we'll start to learn to maybe live with this virus and adjust our interaction. I mean, we're social people. We love to sit down to a meal. We love to go to a restaurant and be across, you know, from people. So I think you're right. You know, some of these, you know, businesses are in danger in the near term, but, you know, you could actually see a renaissance of businesses, you know, in that type of industry, kind of coming back to the forefront if we get past, you know, this interim time and get to a vaccine where people feel more comfortable interacting with each other.
Thank you.
Yeah, I'll just add to that. This is one of the unfortunate aspects to any economic downturn or recession, and this time around especially so, because you know, we're not going into an economic downturn through any fault of any business or any imbalance that has cropped up in the economy. But this is what happens. In economics, it's something called, you know, creative destruction. It's when you have an economic downturn. Some firms fail that were not, you know, efficient or productive, and that gives way to, you know, more efficient and productive firms elsewhere in the economy, where, you know, where we need it, where the current present day economy needs jobs. That's where the jobs will flow to. So that sounds depressing, but in reality, it's exciting for me, because yeah, there's going to be jobs that never come back. There's going to be all these new, you know, exciting new jobs in the future that'll be much more productive, that people, you know, will move toward. So that's actually, you know, the silver lining here could be, you know, this you know, bright new future.
Thank you, Charles. So Jeff, this one's for you. You'd mentioned the glass half full and the stimulus package. You also mentioned that credit is the lifeblood of the recovery. For small business, access to credit is spotty as the small business owners exhaust the PPP funding and their personal resources. They are being declined by their current banks for additional capital. What do you see as a solution?
Yeah, that's a good question, because you know, I said that the credit is the lifeblood of the economy, and the other lifeblood of the economy is small business. You know, and it's very appropriate. I'm speaking at the VICA conference, you know, this morning, and you know, a lot of small businesses in the LA area are really the lifeblood of the economy. We think of these big corporations, but at the end of the day, it's Main Street, it's the mom and pop stores, restaurants. You know, I mean, you can think of so many businesses that are important, are the fabric of your community. So the question is, when the money runs out, the PPP money, and businesses have a more difficult time accessing credit, what do we do? What's the playbook? Well, it's an important issue, and without small businesses and businesses around the country growing and expanding, it's really going to be difficult for our economy to move forward. So with that being said, hopefully we can bridge the gap to get to the other side when we get a vaccine and some therapeutics. But if we can't, there may need to be additional programs, by fiscal stimulus by Congress, or additional programs by the Fed or by banks to make credit more available to small businesses, because we do need small business to be healthy in this country, or we just can't have a sustained economic recovery.
Thank you, Jeff. Is there anything you would add, Charles?
I agree completely. And thankfully, I think the Federal Reserve agrees completely too. Yeah. If you listen to what they say, what Jay Powell says, or any of the bank presidents say, they are very attuned to this very issue, and they are going to support credit, the flow of credit to households and small businesses in any way they can. So, they've shown that they're more than willing to do this, and that they certainly will continue to do so. So that makes me very optimistic about that.
Thank you. So the next question is, and it is for both of you, technology stocks have been the shining stars since the work from home orders. Do you see this continuing, since the work from home will continue to be a part of our lives for the near future?
Yeah, maybe I'll take that first. We get a lot of questions from our clients about that. Tech is really run, and it looks great. And, investors have made a lot of money. So the question is, hey, is tech still good for the long term? And, our equity research team here at US Bank would have to say yes, because we are kind of in a transformational time with regard to work at home, productivity, all the e-commerce, the cloud, just the way we're interacting and doing business. So we really do favor companies which are levered to e-commerce, companies which are levered to machine learning, artificial intelligence, the cloud, those types of companies. And sometimes they're not all in the tech sector. Sometimes they're in other sectors, but they're focused on those aspects of productivity. So we do still like technology. We do believe technology has run a lot here. We won't be surprised if we get a bit of a pullback, but for the long term, technology is a key driver of the economy, and we do still like technology.
Thank you.
Yeah, it's if you think about the effect of technology, it's like we're just kind of getting started, and what the tech sector is broadening through every part of the economy, right? Think, I could go, if I go out and buy a car right now, it's probably going to have an iPad essentially. Yeah. If I go out and buy a refrigerator, it's going to have a big screen on it. So every part of our economy is going to use these new technologies. So there's going to be more integration there, as we move forward. And of course, the work from home, that's probably going to accelerate things as more and more people are kind of forced to sit down and say, okay, this is how you use technology. This is how easy it is and efficient it is. And so there's going to be more and more technology adoption, and that's just going to push us forward even more.
Thank you. I think we have time for one more question, and then I'd like to go to both Jeff and Charles for parting comments. But the last question, I'll start with Jeff, because I think this is appropriate. And the question is, buy, sell, or hold. Let's say I have $25,000 in cash. Where should I put it now?
Oh, wow. That's kind of a tough, that's a tough question. I think, where you put your money is quite dependent upon your individual situation, right? Some clients like a lot of risk, so they buy stocks. Some clients don't like a lot of risk, so they buy municipal bonds. A lot of clients do both. So, where to put $25,000 really does depend on your individual financial situation, your need for cash, in the near term. What I will say, because I think it's timely right now, because the election is just a few days out. So a lot of our clients are sitting on a lot of cash, or they don't know what to do. And the question is, should I do anything big before the election? Should I buy a lot of stocks? Should I dump all my stocks? Our attitude is really just take a step back, take a deep breath, remain focused on the long term. And we really are advising clients, don't make any big changes to your asset allocation, because there's a lot of unpredictability. And that chart I had said, hey, remember that chart about timing the market? Missing the best days really does hurt you. So keep that long-term perspective and don't get too wound up about the short-term market volatility, with the election or news on the virus.
Thank you for that, Jeff. Charles, any parting comments?
Yeah, so my parting comments would be, it's been a really turbulent past few months. And I'd like to just leave everybody with, we are certainly on the path to recovery. It's going to be a long climb back up. But what's important is that we are sort of on that path, and we are getting better. The economy's improving. The trajectory of the coronavirus and the pandemic is still very uncertain, but there's a lot of encouraging news in terms of testing capacity, in terms of new therapies, and especially, vaccine development, which, globally, there's something like 200 vaccines being developed right now. So that's very encouraging. The economy is improving. Sometime next year, we'll get back to where we were. Overall for California, it's still lagging behind a little bit, but again, making a lot of progress. And these days, what you want to see is progress being made. So that's heartening to see. So overall, yeah, the economy's on the up and up. It's going to be a long road ahead, but that's sort of where we are.
Thank you for that. And Jeff, I will ask you for your parting comments as well.
All right. Parting comments for me is, despite all these issues we're having, uncertainty about the election, the COVID crisis, we're actually pretty optimistic about the economy. And, we as Americans are so resilient, as consumers and participants in the economy. And what really gives me encouragement is the huge fiscal stimulus that we've gotten from Congress and from the Fed, all the monetary stimulus. So that's really going to help us bridge that gap. So I do feel optimistic that we are going to be able to get to the other side, and Americans overall, considering what's happened, are doing incredibly well. And I will give a shout out to California. California is really one of my favorite economies. It's the 5th largest economy in the world. I know California has issues, high housing prices, things like that. But you know what? Californians are the most creative people, I think, in the country. They turn dreams into economic reality. They lead when it comes to technology, when it comes to film and entertainment, agriculture, real estate. I mean, you could go so many industries. So California, despite going through a difficult time now, I wouldn't count California out. California has a very bright future.
Thank you very much for that, Jeff. Well, that's all the time we have for our questions today. And I'd like to thank our economists today for joining us and giving us such great information this morning. If we were in person, you would be getting a big, huge round of applause. So thank you.
Thanks.
Remember to visit all the exhibit booths. There's some great prizes: Southwest airline tickets, Los Angeles Rams jersey, a 2-night stay in a Synergy property, and there's an assortment of gift cards, just to name a few. So I know I'm going to go visit all the booths. So at this time, our breakout sessions will begin at 10:10 a.m. So you have 10 minutes to go visit your amazing exhibit booths. And one more time, let's thank our economists and our sponsors for this morning. Thank you.
Thank you.
Thank you.
Have a great day.
All right.